Hi, guys. Welcome to the How I Raised It podcast, the show where you get an inside, unfiltered look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Shomik Dutta of Overture. Overture is a climate-focused venture capital firm. Shomik shares his two paths for breaking into venture, tips and tactics for climate tech startups that are raising capital, why he believes climate is a massive opportunity for aspiring founders, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out foundersuite.com if you're a startup or fundingstack.com if you are a VC or advisor to get an awesome collection of tools for raising capital. It includes a massive investor database, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now enjoy this chat with Shomik.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com and fundingstack.com. Today I have Shomik Dutta of Overture Climate VC coming to us from Santa Monica. How's your day going?
I'm good, Nathan. How are you?
Very good, very good. Well, let's jump right into it. What do you guys do?
Overture Climate VC is an early stage venture fund focused entirely on climate. We invest across energy and storage, carbon removal, transportation and mobility, software and hardware in North America and Europe. We're a $60 million fund one. Our thesis is that the United States government, state and local governments collectively are going to be a profoundly important sector in shaping the outcomes in private sector technology in climate. They are both the referee, the banker in some cases, a buyer, and yet a lot of climate startups come out of Silicon Valley or out of academia and don't know how to think about government. A lot of them were taught to move fast and break things in the last couple of decades. And yet when it comes to FERC or transmission technology, it turns out that the United States government has a lot of equities in that and is going to have something to say whether you like it or not. And so we as an investment fund are purpose-built to help these climate startups navigate complicated government and regulatory issues. We invest in cheaper, faster, better venture scale outcomes. We are looking for market signals of founders that can build things that are decarbonized, but that can beat fossil fuel equivalents. But along the way, there is $1 trillion wall of money from the IRA, CHIPS bill, and infrastructure bill. There are a set of generational rules being passed now to regulate industries of the future. And we think being able to shape those, understand those, and have an investor and coach on the sideline that can participate in rounds, differentiate capital, but also make a difference in your commercial trajectory can be enormously useful and produce alpha in the market. And so that's the sort of thesis of the fund. I built this with three of my closest friends in the world that all come from different flavors of the Obama White House. One was a founder and operator who has built several businesses that have exited over $1 billion in collective value. Another was the chief of staff at the U.S. Department of Energy, who started the loan program and started the ARPA-E program and ran the department for Secretary Steve Chu for a number of years. And so we've all come together. A third was a longtime fundraiser for the president, actually, as I was, and worked at Airbnb afterwards in state and local policy. And so we've built this interesting team and this interesting capability. I oscillate between extreme fear and total elation. And so having a lot of fun.
Awesome. That's good. I want to get into, so good thesis, good team, sounds interesting. I want to get into the kind of government bridge role that you guys play, but before that, let's get into just a little bit on the backstory. So you're working with the Obama administration. Kind of tell us, why'd you decide to raise a venture fund and how it all came together?
Yeah. Well, so that was the first half of my career, was politics and government. I worked for the president's first campaign. I was one of the earliest hires and got to run the Mid-Atlantic region for him and then work in the West Wing, which was a blast. I went off to get my MBA after the reelect, went to Wharton, and then shifted my career into investing. So I've been investing professionally for about 14 years now. But I've, been have this rooting in government and politics that I've always loved. And I honestly just wanted to find a way to stitch together all the different passions in my life: investing, early stage entrepreneurship, government and politics, and climate. And it was sort of, this fund was purpose built for me to be able to work with the people I love the most on the things I find most interesting. And so that's how we got here.
What were you? Where were you an investor before? Were you at a bigger fund or another fund?
I built a impact venture fund called Higher Ground Labs before this that still runs today across 4 funds, investing in civic and political technology to modernize the Democratic Party's technology stack. Prior to that, I worked briefly as an investment banker at Morgan Stanley, and worked in private equity and renewables, building utility scale solar assets around the world.
So the focus on climate and this is heavy lifting. Everything you're doing. Capital intensive heavy lifting, like why this market is because it's what or because you're a bleeding heart green, or because you just see a huge opportunity, or probably some combination?
It is more of the latter than is sometimes allowed to admit in a cocktail party if you want people to like you. But it really is that I missed the internet entirely. The internet was probably one of the greatest wealth generation opportunities of our lifetimes. And I missed it because I was so focused in politics. And I think climate is 200 times the opportunity of software, right? Like software, I always say, is about a $600 billion a year global market in revenue. Climate is a 10 trillion in EBITDA at stake. And so these are the most mature, large corporations in the world that are going to have a very short period of time to completely reinvent the way they do fundamental things, like produce cement and produce steel, to move goods and services. These are gigantic liquid markets, and it is never the case that those old conglomerates reinvent themselves quickly. It is always the case that founders and early stage entrepreneurs drive innovation. And so that's the logical place for me to spend time. And then the question was, how do you differentiate capital in the early stage? There are a lot of seeds funds chasing a lot of deals in climate right now. And the best founders have the ability to sit back and say, why should I take your capital? And if the answer is yet another go-to-market and pricing and general strategy fund, those are sometimes hard to differentiate and win deal flow in. And so we wanted to build something that would be impossible to deny. And I love that Steve Martin line, be so good that you think that you're undeniable. And so that's the sort of line for us, right? We want to be able to provide something that's elsewhere unavailable. Usually these lobbying firms charge $50,000 a month. And if you're in the seed series A, you simply can't afford that. And so we want to get in there and shape rules for these companies. And we do this in partnership with one of my best friends' government affairs firms, which is called Boundary Stone Partners, which has 75 full-time executives across all the branches of government in climate. And so when we invest, our founders get free access to this lobbying firm as though they're paying customers for a full funding round. And so they are getting best-in-class advice on how to shape rules out of the IRA. As an example, one of our best companies is called Antora, which is a thermal battery technology. Antora is decarbonizing industrial heat and backup power, which is an enormous market, about $140 billion market in North America alone. Antora, which is building these thermal batteries, did not qualify for a provision in the IRA called 45X, which is the uncapped tax credit at the heart of the IRA. It's the most lucrative and important tax credit, arguably, in the entire bill. The Boundary Stone team and Overture launched a full campaign to ensure that all thermal batteries would qualify for 45X, which successfully happened last year. And that transformed the pacing of all thermal batteries. And so we can help adjust rules that can be, consequential for whole sectors of climate, which I think is a positive externality of the whole industry.
Interesting. Okay. You've kind of answered, my next question of how you act as that bridge between government and helping these startups navigate what I'm sure is a difficult road, right? Dealing with government and lobbying and rules. Any other good examples of kind of how you help companies along that journey?
Yeah, there's been another tax credit in the IRA that's called 48C. Now, 48C is capped. There's only so much capital to go around. And we've helped multiple companies qualify for millions of dollars of 48C tax credits and millions of dollars for a Series A company. For example, one, which is called Moment Energy, is repurposing used EV car batteries into on-grid storage opportunities.
Cool.
Use lithium-ion batteries as like they're new at about a fraction of the cost. And they qualified for $6 million of 48C credits. And as a Series A company, that is enormously consequential in managing your dilution. And so to your earliest question, Yes, we will invest in hardware. Yes, some of that hardware can be incredibly capital intensive. But if we can both differentiate our capital on the way in and change the capital intensity story of the company on the way out, helping them access ultra low cost debt from places like the Loan Programs Office at the Department of Energy, helping them access grant funding and tax equity credits and other things that can help them raise less equity and help us change the profile of the company over time, that's enormously consequential. And they're competing in, trillion-dollar markets sometimes, like steel. And so that's a bit of the sort of flavor of work we want to do for those companies.
Very cool. And on the website, we've got under climate, we've got ag tech, carbon, climate management, energy, industry, and transportation. All huge industries. What are your favorite babies? Or where do you see maybe the most interesting startups coming out of or opportunities? Yeah.
Look, for us, we always say this. I don't know what it means to be investment thesis driven at the seed and at the Series A. We are incredibly founder focused. It's almost always the case that world-class founders will bring us ideas that we had never occurred to us, and they are usually closer to the problem and have thought more deeply about solutions. And so for me to filter with a preconceived notion of where the capital should be going, to me is a wrong-headed way. And so we're incredibly founder reactive. I will tell you a couple themes, maybe if that's helpful, of things I lose interesting for the next 10 years. One is in critical minerals and metals, the most upstream problem. Climate is said to be a mining problem first. And in rare earth elements, in lithium, gallium, copper, there are a lot of things we need way more of that are very hard to get out of the ground. We've plucked the lowest hanging fruit, and giant mining companies are now buying each other. As you probably watched, BHP made an unsolicited bid for $140 billion to take over Anglo American entirely over the copper story, right? We need in the next 20 years, we're going to use more copper than we have collectively over the last 120 years. Copper is in every single electric vehicle, solar panel, wind turbine, and also in everything else we use in consumer electronics. And you need about 12 times more copper in an electric vehicle than an internal combustion engine vehicle. And so in a shortage of a 2-to-1 deficit projected to grow over time, and when the average mining company mine takes about 20 years to come online, we're going to need to get much better at extracting copper in creative ways. And so applications like computational biology become incredibly interesting. So those are, and when you put that in the context of a second Cold War that is now here with China, in which we are restricting semiconductors to China, and they are responding by restricting gallium and graphite and other important things. China controls 99% of the world's graphite production, 99%. They extract and process some of the dirtiest things that we don't like to look at, that produce metals that are incredibly important for every input, not just in electrification, but in the Defense Department. And so investing in solutions against that thematic is incredibly interesting to us. Another interesting sort of thing that is brewing, that is no surprise if you read headlines, is the sort of power needs in this country are running us through what everyone's calling an electricity gauntlet that is looking increasingly dire. If you're running a big business that is power intensive, you are going to face rapidly increasing costs in electricity and electricity availability. And as all of industry starts to electrify, fleets of trucks start to electrify, and AI data centers start to gobble 10x the power they used in previous chips, that's going to create a very interesting opportunity for people that can flex demand, that can move, load shift, and utilize storage and software in interesting ways.
Yeah, very interesting. I just had 2 days ago, I had the CEO of X Shore on the show, which is making electric boats, kind of the Tesla of recreational boats. Pretty cool stuff, though, and they're thinking about a lot of these same, issues of how do we tap the grid and make the use of the grid so we can actually build competitive, to gas-powered engines. Pretty cool stuff, what's happening out there, both with what they're doing, and many others. On the critical metals part, I just have to ask, have you looked at any asteroid mining startups?
I'm sure the cost per kilogram of launch is going to get so low and the opportunity will be so exciting that it'll fit at some point. It's hard for me to understand that stuff in a 10-year period. And I would say like Silicon Valley has this observed fetish that the crazier something sounds, the more people are into it, because that in this Peter Thiel thing, if it sounds like a bad idea and is actually a good idea, you should do it. But I just don't know enough, and I don't have any edge in understanding how those things should do. We do have one exciting space startup called Privateer, which is helping to anybody that's operating an asset in lower Earth orbit understand where everything is and how to reposition your satellite to make sure it doesn't hit anything, which is increasingly important when something the size of your fingernail can take out $1 billion satellite. You're going to want to be very careful. And so Privateer recently actually just raised a $50 million Series A, $30 million Series A, excuse me, and acquired another company called Orbital Insights, which was Sequoia backed. And so they're growing very quickly and quite an exciting company.
That's interesting. Cool stuff. Well, let's get into any more themes. Have we covered some interesting things there?
There are many more, but we can move on our board. I mean, the last theme I would just flag is that adaptation and resilience are just necessary parts of any climate fund, in our opinion, right now. I mean, if the purpose of all of this is to allow human life to flourish, extreme heat is just here today, right? It was 117 degrees Fahrenheit in the Florida Keys just last week, which is unheard of. In Tehran, Iran last year, it clocked 156 degrees Fahrenheit. And so there are 3 million Americans that work outside every day. How to keep them hydrated and safe in those temperatures, and how to keep operationally our food systems and our transportation systems that may buckle, runways might buckle under those kinds of thermal conditions. And there is a theory that photosynthesis itself will not function at certain thermal limits. And so how to bring agriculture indoors, how to ensure about water availability and just-in-time inventory needs when you are experiencing extreme heat. That's just one flavor of the adaptation work we're going to need to do. You can now think about all the others, from animal-borne diseases to mosquitoes. These are all problems that are here today that are coming for us. And so investing in, computational biology and synbio solutions to things like diseases born from malaria that are now coming north of the equator for the first time in history, those will be, essential stools to the solution.
So, all right, let's shift gears here and talk about raising the fund. You had a couple colleagues in mind. You had some themes and theses. How did you go about it? Get as granular as you're willing.
Yeah, Nathan, to grossly oversimplify, in venture capital fundraising, I feel like there's two paths to take. Path one is to be purpose-built for an institution. You have an existing track record at a world-class fund and can go to a pension fund or an endowment and make a very credible first pitch. Those types of firms generally own 15% of everything. They're leading 80% of their rounds, and there are no surprises. That was candidly just not us. We had a lot to prove. I've never worked at Sequoia. I don't have a 15-year track record in venture, and it'd be very hard for a university endowment to understand me out of the cold. And so the second route is to start with people you know and to hand fight for relatively smaller checks and prove yourself with a track record that becomes undeniable. And that's what we did. So, in political fundraising, Emily's List, which is a well-known pro-choice organization, starts with concentric circles of fundraising. And the concentric circles start very small and they get big. And in the smallest circle is just people you know. And the reality is the people that knew us, knew our track record, knew what we were about, as uncomfortable as it is to go to them, it becomes the necessary launch point for a lesser known fund that isn't going to be a door opener to Cambridge Associates. And so that's where we started. We started with a lot of folks that worked with us closely on the Obama campaign, folks that were ambassadors and big fundraisers that had 15-year plus relationships to us. My co-founder, Tamim Morad, who's a serial entrepreneur, has a crew of founders that he's built very successful businesses with. They invested with us very generously. And from there, we expanded. We're lucky to have been blessed with sort of series of fundraising closes. So we didn't do one big close. We did bite-sized closes and rolled them over the course of 18 months. And that allowed us to show and not tell investors about deals. We did deals right off the bat. Some of them got marked up generously and had world-class investors come in behind us. And that allowed later more risk-averse, more institutional-facing LPs that knew us less to get to know us over those 18 months. And we're very lucky to have welcomed Schneider Electric in. Their venture arm, which is SE Ventures, invested in us. We're lucky to have included Woven Earth, which is a great fund of funds in climate run by a woman named Jane Woodward. Those LPs were able to underwrite to a generously sized portfolio of about 16 companies by the time they invested. They were able to look at the underwriting and sort of understand what they were walking into. And that really made a great deal of difference. Now, that does put pressure on your next fund because you've been investing through an investment period of about 2.5 years before final close. But I think all said, because we were able to weather a banking crisis, right? Silicon Valley Bank blew up. We had First Republic blow up. And we had companies with fresh capital in their bank accounts that were temporarily gone. And so we weathered some dark moments, but I think resilience is a critical component to starting anything, and we were resilient. So I'm really proud of that team.
Interesting. Okay, so did you start off aiming for a $60 million first fund, or did you start smaller? And maybe even let's get into a little bit more on that consent or bite-sized closes. Did you start with 10 for the first one, then scale up a little bit, or what?
We did a $5 million close for the first close. And went from there. And so, I think not being a purist on how big a first close needs to be, but just getting something done and keep moving. In the same way that you don't launch a perfect car as a product, as a startup, you launch a skateboard and you just get started and see how the market's reacting and keep going. And so I think not having some arbitrary number that sounds impressive and rather just getting started is really important for momentum.
Were you always aiming for the 60 million? Like, was that part
No,
of
it was a surprise to the upside. We aimed at 50 and were surprised and grateful to get to 60.
And one more on this topic. We do get into the weeds on this show. I should have forewarned you, but okay. So going out for 50 million, first close 5, and then what is it? Like every 4 months or so, it's another 5, 10, something like that. Like, how did you kind of stagger it?
I mean, you just grab whatever's on the kitchen counter when you're hungry. And so, whatever the amounts were that we were able to close on a monthly or bi-monthly basis is what we did.
Gotcha. All right. Maybe let's talk about, it sounds like, if I'm interpreting what you just said, you started with a lot of individuals, high net worth folks, and then eventually progressed to, a little bit more institutional, like Schneider Electrics or Electronics. Was there any strategy on that, in that transition of going from sort of individuals to firms, entities?
Yeah, I think once you have a wide enough AUM base that it has some, positive signals to it. Some of the most prominent family offices in America are some of our LPs, which we're super grateful for. And the ability to have closed them, had their underwriting done, really helps position you well with some of the larger strategics and more institutional investors, coupled with, again, the portfolio in place, founders that are willing to say, I've worked with Overture, and this is what it looks like, and this is why I'm happy they're here. And markups, right? Some of our companies have marked up and are now worth $500 million on paper, which is certainly useful when you're trying to underwrite to an outcome for a fund. The last thing I'll say is just that just getting started is so important. It doesn't matter what the size of your check is. It doesn't matter what the size of your first close is. Just get started, get in the game. And fundraising without doing deals, if you are sitting out of the market saying, I'm just going to focus on my fundraise and not talk to any founders, I'm not going to do any deals, there's a staleness to your impressions and intelligence of the market that can affect your fundraise. And so as hard as it is, and there are nights where I wanted to tear out my hair where you're both raising capital, building the firm, and fundraising, it actually disciplines you into learning all three of those aspects and the ways they tick and tie together, which are very useful. The last thing I learned is over communicating with your LPs, over communicating with your investors is the stuff that builds your fund 2 and fund 3 strategy. And so some GPs, I've been told, don't communicate very often. They're like, thanks for the capital. We'll come back to you with the marks. We'll see you later. I got to go focus. The reality is, in the same way that a startup CEO is always fundraising, I think every GP always needs to be somewhat in market, always talking to existing LPs, meeting new LPs, and figuring out a sort of portion of your time that is always on for that is, I think, useful.
Yeah, I like that. Let me ask you, I haven't formed this question fully in my head, so it might come out a little weird, but how do you balance the challenge of, let's just say you did that first $5 million close, you have startups, deal flow, you want to, like you're saying, you want to kind of get things in motion and be doing deals, making investments. But I'm imagining some of these companies are pretty capital intensive. So how do you kind of balance that trade-off of like the start comes in needing a lot of money over the course of their life, and you've maybe only closed that first. You can talk about it in more kind of generic terms, not necessarily your specific, but that balance, right? You don't really have the money to invest in some of these companies. How do you do that? Yeah.
Well, it's a good question. Actually, the hardest question was a derivative of your question. The hardest challenge for us was that it was hard to size our check, right? When you have 5 million in a close and you have no idea how big your final fund's going to be, how do you know what your first check should be? And so the cost of doing rolling closes is that we probably wrote some checks that were smaller than they should have been. And that creates some wonky ownership issues, candidly, that you have to sort of struggle through. So you're either going to take a risk and invest too much capital against what you end up raising or too little. And so that is a sort of candid problem of the strategy I outlined. To your second question, like companies that are going to gobble up endless amounts of equity are not right for venture capital. And so you do have to have a serious look at how much total equity is required of this company. How are they going to stage it? What's their burn? And most importantly, what's the path to get off of the venture capital hamster wheel and get on the project finance wheel? And seasoned teams that have a great understanding of that are bankable in that way, are very attractive to us. And so, companies like Antoro, which I mentioned, companies like Bedrock Energy, which is a very exciting geothermal heating and cooling technology that's in the market now for a Series A. They've invented a rig that can deliver zero carbon heating and cooling to gigantic companies, people with huge warehouses, industrial facilities, commercial office complexes that want zero carbon heating and cooling that can be delivered at a cheaper OpEx and cheaper CapEx to the asset owner. And so things like that are going to find very interesting project finance use cases, and they'll get off the venture hamster wheel quickly, and they can be very capital efficient businesses over time.
Yeah, very interesting. Very good. Are you already starting to look forward to fund number 2, or are you really just kind of digesting and processing and doing deals out of fund 1? Like, what's your...
We are very focused on building a great firm in every way. And so that means doing great deals. It means servicing our founders very well. It means hiring the best folks, which we have. We have, my teammates named Mackenzie Tasai, who's a principal on the investment team, who's extraordinary, and an operations VP named Emma McDonough, who really help run this place and make it special. And so we want to do those things with a lot of discipline, but yeah, we'll always have our eye on what's to come. And we want to build this platform into something great that's, generational.
I've got about 2 more questions for you, and I'll let you go. Any advice we haven't covered for like emerging fund managers? Anything we haven't covered?
I think, again, chewing gum and walking and sprinting all at the same time is very important. So build the firm, do deals, raise money, and let those things bleed into each other, because you'll be surprised by how that can help you shape your story really effectively and know what the hell's going on in the market. 2, not being a purist on fund size, and rather just grabbing what you can off the counter and getting going. Some of the best firms I've ever met started with $5-7 million AUM sizes. And 3, going to the mat on your network and exhausting that network first before you ask for an intro to the Harvard Endowment Fund. Exhaust that first concentric circle first, because you'll be surprised what comes out of it. And, I struggled with this a little bit, asking friends to invest. I felt terrified because I was like, what if I lose their money? I can't sleep at night if that happens. And my co-founder, Tamim, actually pulled me aside, who's built huge businesses and had friends invest. And he said, you're missing the upside. What if you make your friends a lot of money? Imagine that feeling. And so, reframing that helped me go to the network and raise from some of my closest friends in the world.
Yeah, interesting. Those are all good advice. What in particular are you looking for? Check size, stage? We talked about the industries already. Anything else, like if someone's listening to this and maybe wants to pitch you guys, what are you looking for? And then the second part of that, any other advice for like climate tech entrepreneurs? Kind of a broad question, but go for it.
For what we're looking for, we invest in the US and in North America and Europe. We invest in hardware and software. Pre-seed to seed is the area of focus for us. We are not afraid of hardware. And we're looking for world-class founders that have a chip on their shoulder, that have done something incredibly impressive with their careers, that have a commercial insight that nobody else has, and have an obsession. I want to meet someone who's on a missionary obsession to get something done with a mercenary capability to cut everything in their way to get to where they need to go. And so I'm looking for folks that are fast, that are sort of lethal in their ability to build product, and that are totally and totally devoted to something where you can kind of feel that devotion jump through the screen. Unfortunately, we do a lot of diligence on Zoom, which is kind of a sad reality. But we are open for business. We're writing about $1.5 million checks on average, and love to meet folks.
Really good. Yeah, that's great. That's super crystal clear, and also a little advice baked in there too. If you were coaching on a climate tech entrepreneur, any other advice of just how to think about the market or fundraising or anything else?
Look, I think the reality is that the commercial world we live in is the place to have the single greatest impact on climate. And my advice to climate founders is to understand the problems, but then go find a commercial dynamic you can disrupt that will solve that problem, and obsess over that and not just over the problem. The problem is important and we have to fix it. But if you build your product or your solution entirely framed around the problem and not the commercial dynamic that will disrupt that problem, I think you're dead in the water.
Yeah, that's great. Very good. I love this. If people want to learn more, it's overture.eco. Anything else you want to plug or call out today?
No, just thanks. I hope there are founders listening and that they're hungry and they want to go build, and we want to be their partner along the whole journey. And it's nice to meet you, Nate. Thanks for having us on.
Thank you very much. Appreciate it, and keep up the good work. I'm an eco nut at heart, so I like to kind of feature folks like you doing good stuff and making a business out of it too. So I like it.
Good stuff, man. Nice to meet you.
Over now.